Now we're going to look into short selling. A lot of people don't know that you can actually make money when the stock is falling in its price as well. A simple idea is that you buy a stock at a lower price and then sell it at a higher price, only then will you make profits. But what if the stock's price is falling? So short selling helps us exploit this situation where if a stock's price is falling, you can sell the stock first and then buy it back later in order to make a profit from the negative fall in the price. Let me just illustrate with a simple example. I will first demonstrate a regular intraday trade. A quick tip, short selling is only possible for stocks in intraday trading. If you want to do a higher type of, or if you want to do a short selling in a higher time frame, then derivatives is recommended, which is our module number 4. But for stocks, let's just understand in an intraday example, because short selling for stocks is only available during your intraday market hours. So now let's look at a regular intraday trade. Suppose there's a stock which is at 100 rupees level and it keeps going up and you're expecting it to rise to say 120, right? So what you do, a simple trade is you buy it at this price. That means you will be +1 on that stock. So you buy one stock of that particular company, say XYZ Limited, and you place a buy order on your trading terminal. That means you have +1 stock and your money from your account is gone minus 100 rupees. Right? 100 rupees is gone from your account. Now the stock starts rising at 120. You think it's a good time to book profits. So what you're going to do, obviously you're going to place a sell order over here, and the order will now make your stock position into -1 because now we're selling it, and you will get plus 120 back into your account. 120 rupees back because now the price of the stock has increased. So overall net, what is your position? As far as stock is concerned, you have 0 stock left, that is +1 stock, -1 stock. So total number of stock is 0. What about the money in your account? You had given 100 rupees to the market and you sold it for 120 rupees. So you will see 120 bucks back in your account. That means effectively you have made 20 rupees in profits. Am I correct? So that's -20 rupees for the market. It's a credit that market has given you into your account. And this is how a typical long position takes place. Why? Because you have bought first, you have bought low and sold higher. Short selling is exactly opposite of this. So if the stock price is falling, what we will be doing is doing a reverse trade. So let me show you how that happens. Suppose the stock is at 100 rupees over here. And now you expect there is some bad news, price of the stock is about to fall. So it's falling down, and you expect the price to fall continuously. Okay? And you expect that the price of the stock may go down up to say 90 rupees for that day. So what you do is you sell one stock directly. So you place a sell order before, that is known as short selling. So your order type will be sell and you will go -1 on that stock directly. Now this -1 stock is actually a credit that is given to you by your broker. So what happens is, again, your money account or your money from your account will be deducted, that is -100 will go into the market or the broker's trading account. So your 100 rupees is blocked as a deposit and the broker gives you the stock as a credit. That's why you are able to sell a stock which you actually don't own. You previously did not have the stock of this company, yet you are able to place a sell order thanks to your broker's terminal and they have given you sort of a credit. Now what happens? If the stock keeps falling down, stock goes down to 90 rupees, what you can do is now you can square off your position. That means make an opposite order of buy over here. If you buy, what happens? You get +1 stock over here, right? Buying means purchasing a stock. And your money obviously is blocked over here, so money is also released from the market, so you get money credited into your account 90. Now obviously what is the difference in the fall of price over here? Essentially what has happened is you have sold at 100 and bought it at 90 rupees. If I just reverse it, technically what you have done is you have bought the stock at 90 rupees and sold it at 100 rupees. Exactly what we have done. And that means you have made a net profit of 10 rupees. The net amount of stocks, this is -1 and this is +1. So your number of stocks would be 0. Net credit would be plus minus 90, that means total 10 rupees would be credited into your account, that is your profit, and this is how you do a short selling. It is an excellent tool to exploit when the market is falling down and you are pretty sure that a certain stock is going to fall. And this is how you can actually make money during bad news events as well. But you need to be very careful in case the stock moves in the opposite direction. Obviously, you are exposed to losses as well. For example, instead of this stock going to 90 rupees, if it had gone up to 110 rupees level, that means this would have been your loss. Your trade would have been, you bought it at 110 and sold it at 100, that means 10 rupees of a loss. And this loss can be obviously at any point of time, it can keep going up as well, it can keep going down as well. So you need to be aware of both the sides. Always use stop loss to make sure that your risk is always managed. And we will now look into both intraday examples to drive the point home for how to do intraday trading and how to do short selling. After which we will get into stop loss, which is the best risk management tool that we have when it comes to stock market trading.